Hello friends, welcome to this course. In this course, we are going to learn how to build a financial model. This is one of the basic financial modeling courses that we have under our corporate training e-learning program. In this program, we are going to learn how to build a financial model with a step-by-step approach and how to run a well-organized financial model. We are also going to learn the different analyses which we are going to undertake during the building of a financial model. Let us get started. Introduction to financial modeling. Here, we will understand what financial modeling is. Similarly, we have many other sessions in which we will learn the theoretical concepts of financial modeling and ways to build a financial model. Let us understand what a financial model is. As you can see, the phrase financial model has two words, namely financial and modeling. So, what is a financial model? Financial modeling is the business plan of a company. When we say business plan, it is about the future. When we put all the future information of a company in an Excel through numbers, it is known as financial modeling. In short, we convert future plans of the company in terms of numbers because anything which has numbers will be part of the financial model. Once this is done, we are going to build a financial model. By putting all the future plans in terms of numbers, we try to forecast the income statement, balance sheet, and cash flow. This is the first step to building a financial model. Once this is done, the future income statement, balance sheet, and cash flow is ready. We then utilize this information along with some other information which we have built in the financial model for analysis. Financial models are used in company analysis. If you are undertaking any kind of company analysis, you should first project the income statement, balance sheet, and cash flow, and then should you study the different kinds of analyses. A simple analysis consists of the actual target sales or revenue achieved by the company. What would be the target debt? Deal structuring. Deal structuring involves the structuring of the debt amount or equity, or the different kinds of financial products you should take during the buying or selling of a company. Choosing the right financing plan. For instance, if we need to have some money, the first step would be to forecast and find the income statement, balance sheet, and cash flow. Next, we find the amount of capital needed and then try to identify whether we need debt, equity, or mezzanine, which is a mix of debt and equity. We choose either of these or a combination of these. Valuation analysis. Here, we undertake the valuation of the company and then decide whether we want to invest, buy, or sell at that number. To make this decision, we need a financial model, essential tool of financing. With forecast, we are able to envision what the future numbers would look like. Business decision making. This could be investment, divestment, or any other strategic decision. These are the different applications of a financial model. Understanding Excel. This is a basic version of Excel that we are going to use. I guess most of us are familiar with Excel, but let us take a brief look at Excel. These are the toolbars with different functions that can be used. In the menu, we have Insert, Page Layout, Formula, Data, Review, View, and Developer. Under these are various functions. We have formatting functions, wrap and merge, and center, auto sum, and filter. This is the formula bar. Any formula that you type into the cell will be reflected in the formula bar. On the left-hand side of the formula bar is the cell name bar. If you want to name any cell, you can do it by typing over here in the name bar. I will explain more on this later. For example, if you want to name this cell as revenue, just type revenue in the name bar. Whenever you click on the cell, it will show up as revenue. At the bottom, we have the worksheets. Basic process of financial modeling. What process do you follow to fill the financial model? Financial model has 4 basic steps. 1. Planning. 2. Building the model. 3. Testing and presentation. 4. Use. Planning. What does planning entail? Before building a financial model, a large amount of planning is essential. To make a financial model, you might require time as little as a single day or as more as 2 to 3 months, depending on the complexity of the model. This is the most crucial period for collecting information. Once you have the information, you can quickly build the model. Planning means what you want to do. Let us say that you want to build a financial model for an airline company. To make the financial model of an airline company, assume that you are made the CEO of the airline company and the board asks you to present a 5-year projection. If you are from an IT background, then the airline business is a completely new sector for you. The following are the steps for making the projection. Planning. 1. Understand the industry. Why do we need to understand the industry? We need to understand the industry in order to get familiar with different cost drivers, revenue drivers, the different players in the industry, market shares, parts of the industry, opportunities in the industry, and so forth. You will get a lot of information by understanding the industry. Where do you get the industry report? You can use Google or any other type of analyst in equity research. Alternatively, you can hire writers for doing market research and writing these reports. 2. Gather historical information. You will generally get this information from the audited financials. If the company has existing records, it is a good idea to study a couple of past financial records for a greater understanding. 3. Detailed analysis with different departments. These departments could be costing departments, revenue departments, and sales departments. These departments could be a good source of first-hand information and thereby promote the understanding of the different revenue drivers, cost drivers, and the fluctuations in revenues and costs because they are involved in data handling or going out into the market. 4. Make assumptions. Basically, assumptions are the different drivers which help in building a financial model. Let me give you a simple example of an assumption. Say you want to make a projection for the airline industry. In the airline industry, to project, you need to know the assumptions such as by how much of a hike will there be in the selling price of tickets in the next year, or by how much will the ticket price go up. These are assumptions. The different assumptions that should be made include how will the salary increase, the average salaries, different costs, fuel prices, and the fuel price rise in the next year. We will learn all of these in detail when we do the Excel sheet. Building the model. 1. Build different schedules. These schedules are revenue sheets, cost schedules, working capital schedules, capex schedules, and debt. You have to build different kinds of schedules. Generally, during the course of making a model, people make the model in a single sheet. However, it is best to make the different schedules in different sheets to gain a greater understanding of the process. As you gradually gain a greater understanding, you could make the model in a single sheet. These are generally used during the handling of infrastructure in a real estate project, and the company has at least 30 projects. For 30 projects, you do not need to make 30 Excel files. Instead, you can make 30 models and one modeling sheet. 2. Integration of balance sheet, income statement, and cash flow. These are important. Once this is done, the first phase of the modeling is completed. Testing and presentation. In this phase, you have to 1. Check for errors. 2. Format the model. This is very important because when you make a model and send it to the senior management or the end users, the first thing they see is the quality of the presentation of the model and its formatting. Therefore, formatting is equally important as the making of a good model. 3. Make the dashboard. Dashboard is where you put all the information of the model in one sheet. You cannot pull all the information in the dashboard. Instead, display the key information. Use. Once testing and presentation is done, the following should be accomplished: sensitivity analysis, return analysis, valuation, decision making, any other analysis. This will vary depending on your background. If you are an analyst, you might want to do valuations. If you wish to buy the company, you might have to do return analysis. If you want to sell the company, you should undertake return analysis. Step 1 comprises planning, building the model, testing, and presentation. Step 2 encompasses the use. Step 1 is where you will make the model. It is common for everyone. Step 2, on the other hand, will vary. The use will depend on which side you are on. Standard model format. Standard model formation steps. We have already discussed this. 1. Make the assumption sheet. This is where you put all the information. You put past financial inputs, revenue drivers, cost drivers, financial drivers, investments, and tax information. 2. Make the key schedules. These are 4 to 5 schedules which you have to make. Revenues, costs, fixed assets and depreciation, fixed assets and depreciation, working capital, and financing. There are a couple of other schedules which you might have to make, but these are the most common schedules. 3. Make the income statement, balance sheet, and cash flow. 4. Your financial modeling is complete. Those are the steps in financial modeling. I hope you enjoyed this session. In case you have any questions, queries, or information, do feel free to send us an email or contact us. We will be happy to resolve your queries. Thanks for your time, friends. See you soon in the next module. In the meantime, have a nice day.